Ladies and gentlemen, welcome to our investing podcast. Our guest on the podcast today is Jean Van de Walle, Chief Investment Officer of Sycamore Capital. He has almost 30 years of investment experience in emerging markets and as a portfolio manager of Latin American and global investment markets equities with Citibank, AllianceBernstein, and the Abu Dhabi Investment Authority. He also worked as an investment banker and as a journalist in Venezuela. He enjoys writing and teaching as well as finding great opportunities in emerging markets. Van de Walle holds an MBA from the Wharton School of the University of Pennsylvania and is currently teaching a class on investing in emerging markets at the New York University Stern Business School. Without further ado, let's welcome Jean Van de Walle.
Thank you, Victor.
What a horrible day for the markets, sir, today.
Yeah, these are difficult times. There's definitely a huge flight towards quality and safety and away from international assets and emerging markets in particular.
That's right. These are risky times, like Bill Bengal also says. Sir, you have an impressive investment experience with emerging markets, both as a theoretician and practitioner, which is so rare nowadays given the so many fake market gurus. How have you discovered your passion for emerging markets and why do you find them attractive regardless of their lack of popularity among global investors?
Yeah, well, that's a great question. So I got involved in emerging markets very early, pretty much when the asset class was beginning to be recognized as a separate asset class. So in the late 1980s. And I had been, as you mentioned, I was a journalist in Venezuela when I left college. I spent 4 years writing on business in Venezuela at that time. And after that, I went to business school. And from business school, I went to Brazil. I worked in commodities trading for a couple years and then in merchant banking at Citibank. So I had all this experience in emerging markets, in Latin America in particular. And I had always had as a goal to go into investing, to be a portfolio manager. So in 1991, I got the opportunity to work with AllianceBernstein in New York, that at that time was starting an emerging markets fund. So this is really way at the beginning of the asset class. AllianceBernstein was one of the first firms to raise significant capital to invest for institutional clients in emerging markets, and I was part of that I spent almost 24 years at AllianceBernstein doing that. Now you ask me why am I optimistic on emerging markets? And
After such a good decade.
I must qualify that over my career in emerging markets, I've been through many different phases, and emerging markets themselves have gone through many different phases. So, typically in markets, you have a discovery phase where new investors come into an asset class and they don't really have the faintest idea, right? So when you don't know anything, you can have very high hopes. And so when all these new investors went into emerging markets in the late 80s, early 90s, there was so much optimism, right? Like, when you don't know about anything, you can pretty much give it any price you want. So there were great markets and great bubbles over that period. So that was very exciting. And then there was a phase sort of from the late 90s until the great financial crisis in 2008, where emerging markets were like a decent, like long-term kind of asset class. So if you were a long-only investor, sort of like a Warren Buffett kind of investor looking for value and looking to invest for the long term, that was actually quite an attractive period. You could get high returns and things worked out very well. And then since the great financial crisis, so since 2008, we've been completely in a different environment for emerging markets. And so I have gone completely from being a long-term sort of Warren Buffett investor to being purely an opportunistic investor in emerging markets. And that's very much true today. I think being a long-only sort of long-term investor in emerging markets is very, very difficult right now. So I basically, over the past 10 years, I've been much more just waiting for opportunities and only deploying capital when I think there are very good, 2 to 3 year opportunities. And the current environment, unfortunately, is not good. I am still quite bearish on emerging markets, and I am very underinvested. I don't have a lot of investments in emerging markets right now, and I'm waiting for the next big opportunity, which I think will happen probably over the next couple of years. And the way I identify these opportunities is just purely based on a first price. You need very low entry points to make a lot of money, to find opportunities where you can make 3, 5, 10 times your capital. You need very low entry points, and you need a proper environment. You need an environment where liquidity can flow into emerging markets. And that, in essence, means a weak dollar environment. And right now, we're still in a very strong dollar environment. The dollar appreciates constantly. We're in a massive risk aversion environment where investors from around the world prefer to move to safe havens. And the biggest safe haven is always the US. The other safe havens are too small for large amounts of capital. So in this kind of environment, all the money is flowing to the US, and the dollar continues to appreciate. And this is not a healthy environment for emerging markets. So we need that to turn. When that will turn, I don't know, because we're in a very, very special environment right now. In many ways, the global financial system is quite precarious, and we have the global monetary system, which is a dollar-centric, dollar reserve currency system, which right now looks very good because investors are moving into safe assets, but it also is becoming increasingly precarious as the dollar is being weaponized way too much, and China is rising, and debt levels everywhere in the U.S. in particular are very high. So we ask ourselves sort of what does the next decade bring? It's very, very difficult to have a clear idea. And until we do, I think investors are going to prefer the safety of U.S. assets, because it may be bad in the U.S., but it's still better than other places. We're sort of the cleanest shirt in a basket of dirty shirts. So that's the way I look at it.
Yeah, that's true. Although US equities are quite expensive right now, and we know that markets are cyclical. And thinking about this, do you think that emerging markets equities were also expensive, let's say in 2008, and that might be a reason why they have underperformed the next decade?
Yeah, that's absolutely true. You're 100% correct on that. We had really a very large bubble in 2008, and it was across the board. You can really look at almost any emerging market, and prices were incredibly high. So I use a sort of a parameter for valuations. I use the CAPE ratios, the cyclically adjusted earnings ratios, and I think they work very, very well in emerging markets. And I use dollarized numbers, so it takes into consideration the flows of the appreciation, depreciation of currencies. And in 2008, you had the highest level ever for these CAPE ratios. So in markets like Brazil, which traditionally trades around at a CAPE of around 10 to 12, I think it peaked at almost 30 in 2008. So that's what happens when you have very, very high valuations, and then it can take a very long time to recover from that. So I mean, it's like Taiwan that had a big bubble in the early 90s, and Taiwan only reached those levels this year. They only got back to those levels after a 30-year period. So that's always the case when you have very, very high valuations. It could take a long time. So it's a combination of that. If you look at almost all emerging markets, they haven't returned to their 2008 levels, particularly if you adjust for inflation. Then they're way below, and that's partially because earnings and multiples were incredibly high at that time. But even so, if you look sort of on a CAPE ratio basis, emerging markets were very cheap in 2016. That was the last really good buying opportunity. And since then, they're obviously much cheaper than the U.S. market. But the U.S. market is at like the second highest valuations ever. But relative to their own history, emerging markets have not been that cheap. So, for example, Brazil, I'll mention that again, is basically at its historical average right now. So it's not that cheap a market. Some other markets like India is, I think, at the second highest level ever on its CAPE ratio. And so in general, the emerging markets, I would say, they're about at reasonable levels on a historical basis at this time. Now, what that would change if the dollar started weakening. That typically leads to much better earnings growth and also multiple expansion in emerging markets. So that would give a much more optimistic background, and then I think you could get very, very good returns for a significant period. So that's what I'm waiting for. I'm waiting for a turn in the dollar.
By the way, you constantly publish on your blog, theemergingmarketsinvestor.com, your famous expected returns model, which helps investors better plan for their investment horizon. How reliable do you consider this model being, and how should investors interpret its results?
Yeah, so that's based on CAPE ratios and on, I mean, it's, as all models, it's quite simplistic. What it does very, very well is identify extremes. So like 2008, the model is just shouting, get out of these markets, right? And in 2016, it's just like shouting at you to, invest, invest, invest. But right now, like the only things that the model really tells you is that Turkey is dirt cheap.
Yeah.
And that, find your entry point in Turkey, and you can make, as you have in the past, 3, 4, 5 times your money, right? So that's great, and some of these markets are cheap. In general, and the other thing it tells you is that India at a CAPE of like, I think it's 34, whatever it is right now, that you need a lot of good news to make money in I'm sorry, I said India, right? I mean, in India, the Cape is 34. So to make money in India, you need a lot of good news, right? So if you're investing in India, which is a very popular market right now, because it's like the only good story in emerging markets, right? It's got growth, it's got good companies, and so
Demographics.
people like India, even though the valuations are very high. So the assumption you're making there is that there's going to be a major increase in earnings power for these companies that are going to justify these valuations, and that the very high GDP growth levels will persist in what we know is a very low growth world. I mean, there's no growth anywhere, right? And so those are pretty big assumptions. I've reduced my India positions, and I'm waiting for a lower entry point to get back into India, because relative to the rest of the world, India is just so expensive right now. And it's not that I don't think it's that simple a story, particularly with energy prices increasing a lot and India being an importer of energy. So the model works at extremes. It also, I wrote a piece on this a couple of months ago. It has a good track record, overall in predicting returns, but it really cannot be used on a short-term basis, particularly when valuations are, not at extremes, because there are too many other things that can impact valuations over a 1 to 3 year period. So in fact, in recent years, the model has been telling you to buy Turkey and so forth, and you've only lost money by doing that. So you have to be careful with these models. You have to know what they aim to do. They're not. I don't use them at all like as trading, a short-term trading or instrument. It's much more a long-term like allocation instrument, and I think for that it works well.
Yeah, I don't think you can use it as a market timing tool.
No, you cannot use it as a market timing. It would not bring you good results. In fact, it would have brought you terrible results in recent years.
And by the way, regarding India, I know that Rahul Pal is a great macro investor who is very bullish on Indian equities.
Yeah, I know he has been.
He still is.
Very much, but yeah, he's got a very, very sort of a macro, long-term, like secular view, which I think a lot of investors have. Yeah, I'm not saying it's not a good story, but
but it's expensive.
It's very expensive, and typically when you buy at these valuation levels, it's very difficult to make money. Now, some of these, what the interesting thing about the current environment is that I think this is going to persist. I think we're still going down in the markets, and this is going to create a very good buying opportunities. So, for example, one thing I like a lot. I own a little bit of an Indian bank, HDFC, which is the major bank in India, and the stock is like almost fallen by half. So you start getting really good opportunities for the long-term investor then, who has a good notion of quality and valuation. You just have to be patient and pick your spots, and you'll get some very good opportunities.
If you are not affected by idiosyncratic risks, because the lowest cape right now, I think, is Russia.
Yeah,
close to zero.
Yeah, so Russia, China. I mean, it's not surprising that investors are very timid in emerging markets after what's happened in recent years. I mean, first we have like a 12-year period of no earnings growth in emerging markets. I mean, who's got the patience to survive that? That's a long time not to have any earnings growth in a market. And then you've had the what's happened in China, which was a very popular market. All the funds were enamored in Chinese tech stocks. And you have a systematic effort by the government to destroy value for investors in China. First with the casino stocks, which were destroyed by government policy, which were another very popular part of the market in between 2010, 2015. Those stocks have never recovered. And now you have the entire sort of, U.S. listed sector, which has been decimated. All these very popular stocks that were mainly owned by foreigners. So that's very, very tough. And then you have the Russia thing, which is a complete disaster. So investors, the risk aversion has increased a lot. There are not that many good stories right now in emerging markets. Everything's very complicated. Brazil has a very difficult election coming up, and Turkey. I think Turkey's good, but it's not simple. It's very cheap, so I think you'll make money by investing in Turkey. But it's a very complicated story, and it could take a while for this to work better. So there are no obvious stories. India is the obvious one, but it's very expensive. So it's I understand why investors are not piling into emerging markets right now.
You have mentioned in one of your LinkedIn blog posts that emerging markets' absolute returns have been impressive throughout history, despite the recent decade of underperformance. However, when compared to their risk, you have found that the risk-adjusted returns of individual countries' equities have actually been quite poor. Given these results, do you still consider EM equities being attractive on a risk-adjusted returns basis?
Yes. So these risk-adjusted returns, right now, they're being measured after a 12-year terrible period, right? So, and even so, returns are still okay if you look from 1987 until today, which is basically the institutional period of emerging market investing. The returns are about in line with the S&P 500, with much higher volatility. But this is after a 12-year period of no returns. So it may be if we have a much better decade ahead now, maybe they won't be so bad. But I think the history tells you basically that you don't get much higher returns. You have more high volatility, and that leads into my thinking, which is what I do today, which is really much more opportunistic. I look for those big opportunities, which is historically where really I've made all my money in emerging markets, has been, really buying things really cheap, sort of in a crisis environment, and then waiting for those, multiple baggers. You've had markets where you can make 10 times your money. And so you have to wait for those opportunities. 2016 was a very good opportunity. In a lot of these markets, you made 3-4 times your money. So that's my focus. I'm more of an opportunistic investor. I'm waiting for those moments to arrive. So I call it alligator investing. You're basically, how an alligator basically hunts, right? He just lays in the water with his mouth open, waiting for the fish to go in. And then when the fish wanders in, he closes his mouth. So that's how you invest in emerging markets. You patiently wait for a big fish to come in, and then you chomp. So that's how I work these days. So, and I think there's enough diversity in the markets that you get enough opportunities, to actively get very good returns in emerging markets by doing this.
Which do you consider being the most exciting investing opportunities in emerging markets for the next decade? And which is your view of top-down versus bottom-up approach?
So Turkey, as we mentioned, is probably the most exciting opportunity. I say that with having zero invested in Turkey right now. But I think you really want to you're going to want to go big in Turkey at one point or another, right? In general, I think the commodity producers will do well. So the Brazils, Indonesia, and so forth. So, and then I think also in India, if you're careful and you avoid some of the really expensive parts of the market, you will have a lot of good opportunities as well, because there's a lot of growth there. So those are the areas I would focus on. I think we're going to get a downdraft in commodity prices over the remainder of this year. And that's going to scare people out of commodities, and that's going to create a really, really nice buying opportunities again in commodities. And I think we're going to have a more inflationary decade than the severe deflation we've had over the past 20 years. And that should be quite good for commodities. It should lead to a weak dollar eventually. And so the markets, the typical beneficiaries of that kind of environment, which are the commodity-rich emerging market countries, should do better. So, for example, a market like Brazil, which started the year well, but now is correcting very, very heavily. I think you'll get a really nice buying opportunity in Brazil sometime, probably over the next year, and that could do very well over the next decade. Now, between top down and bottom up, I think both work. You can have either philosophy and do very well, and you can combine both philosophies. So, I think in emerging markets, the top down is very important in identifying the periods that you want to be allocated. Because it's very difficult to make money in these markets, in periods of risk aversion and dollar strength. So you really have to be a really long-term investor to want to put up with that. And particularly in this environment of uncertainty that we face in the next decade. So that's the top-down part. You have to be very careful with that. Once you've decided you want to be allocated to these markets because the macro environment is good, then bottom up can only help you. So having a very good notion of valuation, of the quality of corporate managements, and so forth, that can be very, very helpful, once you've taken the top-down decision to be involved. So, I do both. I'm more focused right now on the top-down because I think that's the big decision at this time, but eventually, focusing once again on the managements and companies is going to be very important. I don't believe in a lot of these big funds that invest in emerging markets. I think they focus too much on the bottom up, too much on, we have 30 analysts and we know the company's better. Yeah, that's very good, but you can't do that and neglect the top down, or else you get really crushed.
That's right. When using a bottom-up approach and construct a portfolio of individual countries ETFs, will you consider the main risk of following this approach? For instance, I take a more active approach when doing this and prefer to buy more of the depressed assets, but I'm aware of the skewness risk when you only buy without selling and you don't rebalance.
Yeah. So repeat what's the question exactly?
which should be the main risks, let's say, when taking this more active
Right.
approach?
I mean, so the risk, you have obviously the valuation risk is always super important. Historically, I mean, the main risk in emerging markets is people don't worry enough about the macro political risk. Emerging markets tend to be very liquidity driven. And during these periods of dollar weakness and when there's a lot of liquidity in emerging markets, a new wave of investors always comes in. They're rediscovering the asset class. And you get periods that are very good. Liquidity is going in, the currencies are appreciating, the economy starts growing more, there's more credit, there's more earnings growth. And then investors lose track completely of the underlying macro risks. So I have a framework where I'm extremely careful of measuring the different macro risks, which are typically currency appreciation, fiscal and current account deficits, and debt accumulation. So during all the good periods, you get these three factors they start from a low level, and over the time that the markets are rallying, they get to dangerous levels. So if you follow those things and you have a good notion of valuations, and I do think the CAPE ratio gives you a really good parameter for that. So if you follow all those things, I think you mitigate your risk tremendously. So that's my approach. And so in the opportunistic way in which I invest now, I think those measures, they also give you a really clear entry point, and they give you a clear exit point. So that's what I do, and I wait for these clear entry points, and I take like a 3-4 year time frame on a country basis that I think that the story will play out over this period, right? So typically, initially, investors, they don't like the market, their valuations are very low. And after a 3, 4, 5 year period, investors are in love with the market, valuations are very high. And meanwhile, the macro fundamentals have deteriorated significantly. So that's the case in Turkey today. You're very, very cheap. Investors are, practically uninvested. And the macro fundamentals have gone from being terrible 3-4 years ago with huge current account deficit, overvalued currency, fiscal deficit, and so forth, to actually they've improved quite a bit. The currency is very, very competitive now. The Turkish corporates are very competitive. Exports are increasing a lot, and so forth. So actually, the market now is much, much cheaper with much better fundamentals. So that's what creates the entry point. So you just want to focus on those things, and then invariably you'll get a 4 or 5 year boom, and things will look a lot worse when valuations are much higher. And if you're aware of these things, you'll be able to time your exit from the market as well.